Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Delta Volume Indicator, a powerful tool that reveals the hidden buying and selling pressure in the market. If you have ever wondered how to spot potential reversals or confirm trends with precision, this indicator could be the missing piece in your trading arsenal. So why not stay tuned until the end of this video, as I will not only explain how the delta volume indicator works, but I would also share a step-by-step trading strategy that you can start using today to improve your trading strategy and your trading results. We first start by understanding what the delta volume indicator is, and this indicator is a specialized tool designed to measure the difference between buying and selling pressure in the market. It provides traders with insights into the underlying sentiment behind price movements, helping to identify potential reversals, trend continuation, or areas of market exhaustion. This is basically what it means. And it is calculated by the difference between the bid volume, and this bid volume is also known as the selling pressure, and is the difference between the bid volume and the ask price and the ask volume. The bid volume being the selling pressure and the ask volume being the buying pressure. When you see a positive delta, this indicates there are more buying pressure than selling pressure, often signaling a bullish sentiment. But when you see a negative delta, it suggests stronger selling pressure, pointing towards the bearish sentiment. Let's not forget that this indicator is also visualized as a histogram or a bar chart. As we can see, it is visualized as a histogram or a bar chart, making it easy to see imbalances at different price levels. Traders use these visual clues to confirm trends or identify potential reversal points. For example, during an uptrend, there is an increasing positive delta can reinforce bullish momentum. When there is an increased positive delta, this signifies there is an reinforced bullish momentum. And a divergence between price movement and delta may signal weak trend or reversal. So let's see how we can implement a trading strategy with the delta volume indicator. To efficiently use this delta volume indicator in your trading, you need a detailed step-by-step strategy. And the first step is to identify your key levels. We start by marking out key support and resistance on your chart. When marking out key support and resistance is very easy. You just need to mark out the highest, the swing highs and the swing lows on your chart. Areas that has been retested multiple times by price. These are basically your swing highs and your swing lows on the chart. These are important swing highs and swing lows on your chart. These levels are areas have historically reacted from, making it easier making it ideal to monitor for potential reversals or breakouts. We use tools like horizontal lines, Fibonacci retracement to highlight these zones. In case you are not good at spotting swing highs and swing lows, you can basically use Fibonacci retracement. As you can see, Fibonacci retracement has already plotted out these key levels that can act as both resistance and support on our chart. The next thing, we monitor the delta divergence, meaning once your key level is set, observe the delta volume for divergence. The divergence occurs when price makes a new high or low, but the delta does not confirm this move. For example, if price forms a higher high at this area If Forex forms a higher high but the delta shows decreasing buying pressure, this could signal a weak trend that could potentially reverse. As you can see in this area, when price made a new high at this area, judging from here, this is a swing high, swing low. When price made this swing high, if you can look at the histogram at this area, we can see it does not support a higher volume at this area, signifying that there might be a divergence and we might be looking for price to trend to the downside. This is basically what the divergence mean. Conversely, if price forms a lower low but selling pressure decreases, it may indicate bullish sentiment building up. So the third step is to actually spot exhaustion at key levels. When price approaches a major support or resistance area, you have to pay close attention to the delta histogram or cumulative volume delta, the CVD. If the delta shows weakened pressure in the direction of the trend as price nears this level, it suggests exhaustion and increased the likelihood of a reversal. For example, during this uptrend, when price was approaching the resistance for the second time, if there is a positive delta and it starts shrinking, it signals buyers may be losing momentum. You can see in this area we are having a positive delta, but it is shrinking at this area. From the histogram, it is shrinking. You can look at this area on charts. That's what it means. It means that buyers are losing its momentum. Similarly, in a bearish market, when price is in a bearish market and we near a support area, you can remember when you mark resistance and support areas, this is a typical, this is a strong support area on my chart, as you can see. So when price reached this support area, if we look at the area on this our volume delta indicator, we can see a decrease in volume at this area. This signifies that selling pressure is reducing. That's why we are seeing a negative delta at this area. The fourth step is to confirm with price action. You don't enter your trade solely based on the delta signals. You have to always confirm with price action. You wait for the market to break the high or low for divergent candle before entering your trade. So if we are to enter a sell trade in this area, we wait for price to break below and close below this resistance before you decide to enter the trade. This ensures that the reversal or continuation is valid, is validated by actual price movement rather than just the volume imbalance. This would have been a very good place to enter your sell trade. The next step is to always ensure you trade with a stop loss. You set a stop loss and you manage your risks, placing your stop loss strategically to provide or to protect against unexpected market movements. So for a long trade, you always set your stop loss below the low of the divergence candle. For a short trade, you trace it above. This is where we place it above your resistance or your divergence candle. This candle over here, where we see price from its last bearish move before it swings to the downside. This is where we basically place our stop loss. This minimizes our risks and allows us room for normal market fluctuation. Now the sixth step is to track the cumulative volume delta, the CVD. We use the CVD gauge, which is this gauge over here. We use the gauge for overall market sentiment over time. If the CVD constantly trend upward while price consolidates at the support, it signals strong buying pressure. You can also use this area. This is the main CVD area, these lines and this histogram, meaning that it signals buy pressure when there is a consolidation at the support area. If there's a little bit of consolidation at the support area, this signals a strong buying interest and a potential breakout opportunity. Similarly, in a downtrend, once you see a consolidation at your resistance period area during this downtrending CVD, during a consolidation, it hints that selling dominance and a possible breakout. This is what we are talking about. Step 7 is combining the delta analysis with other indicators. For additional confirmation and precision, you pair the delta volume analysis with traditional technical indicators such as your moving average, meaning to further confirm or to further strengthen your bias, you can always combine this delta volume with indicators such as your moving average or your RSI. You can use your RSI to always confirm overbought and oversold conditions in the market alongside your delta divergence. You can also combine with your moving average with the CVD trend to identify breakout setup. This is basically what it means. When you spot a consolidation, you would confirm it with your moving average. If price is going to leave and trade above your simple moving average after the consolidation, it signals that price is typically going to go to the upside. Then if it trades after the consolidation in a support area and price breaks below your moving average and is trading below your moving average, this typically signifies that we are in a strong bearish selling pressure. We have to keep all this in mind. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.